The collapse didn't begin with banks. It didn't begin with Wall Street. It began with ordinary people buying homes they couldn't afford and a system that quietly encouraged them to do it. For years, everything looked perfect. House prices kept rising, banks kept lending, investors kept profiting. And then, almost overnight, it all fell apart. Trillions of dollars vanished. Millions of people lost their homes, and the global economy came dangerously close to total collapse. But here's the real question. If the warning signs were there, why did almost nobody stop it?
Welcome to Doc Does Financial History, where money, power, and history collide, and nothing is ever as simple as it looks.
We call it the 2008 financial crisis. But to understand what really happened, you have to look deeper, beyond headlines, beyond stock markets, into the structure of the system itself. Because this wasn't just a failure, it was a chain reaction built over years. It starts with something simple, the American dream. For decades, owning a home in the United States was seen as a symbol of stability. Governments encouraged it, banks supported it, and families believed in it. After the early 2000s recession, interest rates were kept low to stimulate the economy. Borrowing became cheap, money became easy, and banks began lending aggressively. At first, this seemed like a good thing. More people could buy homes, demand increased, prices started rising. But then something changed. Lending standards began to collapse. Banks were no longer just giving loans to financially stable borrowers. They started approving mortgages for people with low income, poor credit, or sometimes no verification at all. These were called subprime mortgages. On paper, it didn't make sense. Why would banks take on so much risk? Because they weren't planning to keep the loans. Here's where the system gets complicated and dangerous. Banks began bundling thousands of mortgages together into financial products called mortgage-backed securities. Instead of holding the risk, they sold it to investors, pension funds, insurance companies, global institutions. To them, it looked safe because these bundles were rated highly by credit rating agencies, AAA ratings, low risk, stable returns. But those ratings were built on one critical assumption, that housing prices would keep rising forever. And for a while, they did. People started buying homes not just to live in, but to invest. Flip houses, sell for profit. Speculation took over. Even those who couldn't afford homes were entering the market, encouraged by adjustable rate mortgages that started with low payments but would increase later. Nobody seemed worried about the future because in the present, everyone was making money. Banks earned fees from issuing loans. Investors earned returns from mortgage securities. Homeowners saw their property values rise. The system wasn't just working, it was booming. But beneath that growth, the cracks were already forming. Those low introductory mortgage rates, they were temporary. When they reset, monthly payments increased, sometimes drastically, and many borrowers couldn't keep up. More missed payments, more foreclosures, and suddenly the assumption that held everything together began to break. Housing prices stopped rising. That was the turning point, because the entire system depended on constantly increasing property values. Once prices stalled and then began to fall, everything reversed. Homes were now worth less than the loans taken to buy them. People walked away from mortgages they couldn't repay. Foreclosures flooded the market. Supply increased, prices dropped further, and the cycle spiraled downward. Now the problem wasn't just homeowners, it was the financial system itself. Those mortgage-backed securities, once considered safe, were now filled with failing loans. Their value collapsed, but nobody knew how bad it really was, because these products had been repackaged, divided, and sold again into even more complex instruments like collateralized debt obligations, CDOs. Risk wasn't eliminated, it was hidden, spread across the entire financial system. And this is where the big short comes in. A small group of investors saw what others didn't. People like Michael Burry, Steve Eisman and a few others began analyzing the data behind these mortgage securities. They didn't rely on ratings, they looked at the actual loans, and what they saw was alarming. High default risks, unstable borrowers, a system built on weak foundations. They realized something critical. The housing market wasn't stable, it was a bubble. So they made a decision that seemed insane at the time. They bet against the housing market. They used financial instruments called credit default swaps, essentially insurance against the failure of mortgage-backed securities. If the system collapsed, they would profit. But for a long time, nothing happened. Housing prices stayed high, markets remained optimistic, banks dismissed the concerns. Some of them even laughed at the idea that the housing market could fail, because it had never happened before, at least not on that scale. Then reality caught up. By 2007, the cracks became impossible to ignore. Major financial institutions began reporting losses, mortgage defaults surged, confidence started to fade. And in 2008, the system finally broke. One of the most defining moments came with the collapse of Lehman Brothers, a major investment bank that had been deeply involved in mortgage-backed securities. When it filed for bankruptcy in September 2008, it sent shockwaves across the global economy. Markets crashed, credit froze, trust disappeared. Banks stopped lending, not just to customers, but to each other, because no one knew who was exposed and how much they stood to lose. The crisis spread globally. Stock markets fell sharply. Businesses shut down. Unemployment surged. Millions of people lost their homes, not because they were reckless, but because they were part of a system that had become unstable. Governments were forced to step in. In the United States, massive bailout programs were introduced to stabilize banks and financial institutions. The idea was simple. If the system collapsed completely, the damage would be far worse, so taxpayer money was used to prevent total failure. But that created another problem. While banks were being rescued, ordinary people were struggling. Homes were lost, savings disappeared, jobs vanished, and many began to question the system itself. How could something so fragile be trusted again? Meanwhile, those who had bet against the market, the ones featured in The Big Short, made enormous profits, not because they caused the crisis, but because they understood it. They saw the flaws before they became obvious. And that's what makes this story so important, because the 2008 housing crisis wasn't just about housing, it was about incentives. Banks were rewarded for issuing more loans, not better ones. Rating agencies were paid by the same institutions they rated. Investors trusted systems they didn't fully understand. Everyone was focused on short-term gains, and almost nobody was asking long-term questions. The system didn't collapse because of one mistake. It collapsed because multiple parts failed at the same time. Lending, regulation, risk management, accountability. Each one contributed. Today, regulations have changed. Banks are more closely monitored. Risk controls are stronger, but the underlying lesson remains the same. Financial systems are built on trust, and when that trust is misplaced or misunderstood, the consequences can be massive. The 2008 housing crisis reshaped the global economy. It changed how people think about banks, about markets, about risk, and it exposed a reality that many had ignored, that even the most stable systems can fail if their foundations are weak. Because in the end, the crisis wasn't just about numbers on a screen. It was about people. Families who believed they were building a future, workers who lost everything overnight, and a system that proved far more fragile than it appeared. If you look closely, the warning signs were always there. They were just buried under layers of complexity, confidence, and profit. And that's what made the collapse so devastating. Not that it happened, but that it was allowed to happen. If you want to understand how the world really works, you have to look beyond what's visible. Because sometimes the biggest risks aren't the ones everyone sees, they're the ones everyone ignores. Because understanding the past isn't just about history, it's about seeing what might be coming next. If you found this video helpful, don't forget to hit the like button, share it with others, and subscribe for more content.